Foued says, if I were in a married put and the stock not moving up, and we're about to have a max loss in the position, was selling an at the money or in the money call spread a good idea? Worst case, we realize max loss if it reverts back higher. Okay, so, well, I don't think I would do I think you're just asking about a call, selling an at or in the money call in this scenario. Not the call spread. You would never sell an in the money call spread, even in the radioactive trading technique. That wouldn't put you in a structure that you want to. Income method number 6, the bear call spread. I don't think that's what you mean. So anyway, let's just let me take something here. I mean, I could use AMD roughly, but sorry, I was looking for a different stock that let's just take Amazon. You know, Amazon's been, around 105 a few months ago. It was in the 90s recently, and it's at 102. So let's just say that at some time in the past, let's say that we had purchased Amazon at around 100. And, maybe this was oops, sorry, folks. Maybe this was back in December. Maybe, it wouldn't be far enough there. It was back in October. And let's say that we had bought a standard April expiration. Okay, standard, I'm sorry. We bought the one stock at 100. So maybe we did buy the 110 put. And at that time, it was around $18 sounds good. All right, so we're going to have a cost basis of 118 for this position, a guaranteed exit of 110. So essentially, we're risking $8. Now, I'm assuming that we've been in this position. I'm sorry, I think I said 10,800. I meant 11,800. My apologies. Yeah, 800 or 6.8% on the position. Now, the stock's trading at 102.51. Why did I use this scenario where I'm only 7 days out in time? Because this is an assumption that we would have done this months ago when the stock fluctuated up and down. Maybe we did reduce some risk with other income methods. But by Foued's statement, he says the stock not moving up and we're about to have maximum loss on the position means you likely held it as close or as near to expiration as possible. So we've lost almost all the time decay, is what Foued is referring to. We're at a 6.8% maximum loss on the trade. Now, the stock at 102.51, I've only got 7 days to expiration. Maybe I should have used 30. We might take a look at that. But is it a good idea right now to try to get some premium out of this by selling, let's say, the 103 at the money call for 140? Is that going to reduce the risk? Yeah, but only by, 0.5% or so, right? Our full risk was $8. We're generating 140 against it. So the risk in this case, in the best case scenario, which does create sort of a bear call spread, maybe that's what you meant, Foued, by doing the same expiration. If it stays down, you're only going to lose 5.7% instead of the 6.8%. Great. So that's a, roughly 1.1% reduction in the risk. My apologies. Is that better than 6.8%? Yes. That could be argued. In the short of a time frame, that's it. Notice the maximum risk, though, goes up to 11.7%. Not quite double what you started off with, but into the double-digit range. So in the next 7 days, if Amazon has a strong run and now moves up above 110, you could have a higher loss than you initially would take right now just liquidating the position. This reduced loss only happens if the stock stays below that short call strike price. There's another caveat with this, and we'll talk about that in a moment. Well, let's get more premium to reduce the risk more by, say, selling the 100 call. That's going to look like a similar risk-reward profile, Foued. But it's speculative because now you need the stock to drop another $3 in the next 7 days to reduce the risk to only 4.1% from 6.8%, and you're in a dangerous position here. Let me explain why. When you own a stock and you own a put, the put that you purchased gives you the right to force someone to buy shares of stock that you own at this price, even if the stock falls 50%, 60% or more. That was our initial married put with the 110 put structure. When you sell a call against a stock, you have an obligation to deliver your shares of stock at this in-the-money call strike price if the stock is trading anywhere above this position. That's an obligation that you entered. Not a right that you have, but an obligation that you entered. Do you see the problem with this scenario? Come next Friday, the stock's at 104, 104.50, or 105. You have an obligation to deliver your 100 shares of stock at this short call strike price. If you don't manage the position ahead of time, you hold it through expiration, stock's at 104, 105 between your two strike prices, Foued. Your obligation takes precedent. You're obligated to do this. You have to cover this obligation. So your 100 shares of stock is used to cover this obligation to deliver shares of stock at 100. And then you didn't sell to close the put. You would have to sell to close the put before the close Foued in this situation. Why? Because your broker sees that you also have an in-the-money put option, which gives you the right to force someone to buy shares of stock from you at 110. You don't own those shares anymore. Those had to be used to cover the obligation first in your account of the covered call that's in the money. So now what happens on Monday? If you left this structure it is after 4 o'clock, did not close the put, roll the call, or do anything to the position, and the stock's between the strike prices of this bearish structure you created, come Monday morning, you're going to be short 100 shares of Amazon at the 110 strike. Because they assumed that that's what you wanted to do, because you didn't sell to close the put. You leave an in-the-money put open through expiration, they assume you want to exercise it, which means if you did have the stock, you'd force someone to buy your shares of stock at $110. Since you had to use that to cover the obligation of 100, you own no stock, you're now borrowing stock from your broker. Monday morning, you'd be short shares of Amazon at 110. Now, if it stays right at 104, sure, you could sell to close them at the market at 104, take the $6 loss. Monetarily, be the same place here if you had sold to close the put before the expiration. But again, this is something that can happen in this case. You have to be careful with that, because if you end up being short shares over the weekend, come Monday morning, the stock spikes up to 112 or 113. Now you've got to pay about $11,300 to cover your obligation at $11,000. It's going the wrong direction and you're losing money. So now you've just added $300 of risk onto your position, because you took in the $11,000 payment for borrowing the shares of stock, but then you have to pay back $11,300, $11,400. Your max loss goes back up to that $860, $870 level in that case, because you were assigned here on that position. You're still in a loss area here, but if it ramps up because you're short shares of stock, okay? That's why I don't do this. Even with this structure by itself, remember, your obligation can be assigned early at any time. So even if you thought the stock was going to drop here, but it hangs out in no man's land at 101 or 102, sometime next week you could be assigned early in that position and be at this loss of 650 or so when you were hoping best case scenario for only 467. And you still have the in-the-money long put open, which, yeah, now you could sell to close it. But as you mentioned, all the time value's out of it. All we have is intrinsic value in this situation. We've lost or are close to that maximum loss in those situations. Just selling a call in these scenarios, income method number one, selling a call below the put strike price, even if you have time remaining, is going to create a bearish structure. If I had a June put and I was selling the April lower strike calls because my stock was hesitating, didn't move up as I expected, and I wanted to get some premium, so I sell the 105 call here, you create what looks like a calendar put spread. It's a bearish structure. Then, of course, if it starts to move up, you could be assigned early. You have to remember that. It's not just like a standard covered call. Doesn't happen that often, but it's just something you want to keep in mind of, because that's going to change the dynamic and the expectation of your trade. But again, if it's the same date and you end up between the strike prices, you may run into that problem if you don't actively close the put before Friday expiration. You may end up being short shares of stock because the stock had to be used to cover the obligation that you entered, which comes first, rather than the rights that you have with the put option itself. I hope that answers your question, Foued, of course. Please give me any other feedback, follow-up, or ideas that you might have related to that discussion that we just went through. Why I don't like to sell a call below the put strike price, why the blueprint always recommends selling the call at or above the put strike price, even if you're trying to do it as a quick management, for example, because the position had moved away from you and want to cut a 6.8% maximum loss that we're near down to just a 4.1% or so, use the in-the-money call. It's still aggressive because you need the stock to fall. You can end up in that awkward position. But even selling the at the money or out of the money, 103, 104, 105, will still create a bearish structure. Would it reduce the risk a little bit? We saw the 103 strike would have reduced the risk down to 5.7 from 6.8. And what that would end up happening in that case is, as long as it didn't go above 103, it'd be fine. But if in the next week it does go above 103, you're in that situation. You only reduce the risk by 1.1%.